Hello, good morning, everybody. I hope I'm audible now.
Can you hear you?
Yes, you are. Yes, all good now.
Okay, thank you.
Good afternoon, everyone. Today,
ठीक है चलो स्ट्रीमिंग स्टार्ट हो गया भेज दे दूसरे कॉलेज में डाल दे दिया ना तेरे हाँ तुझे किया है अश्विता को
Hello everyone. Hello sir. Hello ma'am. How are you all?
Good. Thank
Yeah,
you.
good. Yeah. Good morning.
Good morning.
Yes, very good morning to all of you.
Good morning, Mr. Venkat.
Yes,
Good morning.
yeah. Rahul, all the panelists are there.
Yes, sir. We're waiting for few others to join.
Pardon?
We're waiting for few of the attendees to join, sir. We'll wait for
Okay.
5 more minutes and then we can start.
Not an issue. No issue. Right. Okay.
We are waiting for one more panelist to join. Once he joins, we can start. Yes, sir. There seems to be some issue with logging in. We're checking with the panelists. Yes, ma'am. We are waiting for one more panelist.
professors, and my dear student fraternity. We are here for the panel discussion on post-budget analysis organized by the Street Forum of NITIE. Street, the finance club of NITIE, is a student-driven committee that works closely with corporate from financial sector and academia to put on interactive events for students. The club focuses on developing skills pertaining to financial markets, corporate finance, economics, and technologies, streamlining the financial services. In the last 7 years, post-budget analysis event has provided us the pleasure of hosting prominent industry leaders. With so much to discuss and learn about the union budget, we are all excited for the fruitful session ahead. Without any further ado, I would like to introduce the panel members. On behalf of NITIE, Professor Venkateshwarlu, who will be moderating the session and is currently working as a professor of finance at National Institute of Industrial Engineering, NITIE Mumbai. He also held the position of Director, Institute of Management Technology, Hyderabad. He has completed various industrial consulting assignments in different domain areas such as cost estimation, cost management, productivity management, benchmarking, productivity and profitability linked incentive schemes for major public and private sector organizations. He has also conducted several open training programs in the areas of cost management, productivity management, benchmarking, financial analysis and analytics, financial risk analytics, etc. We welcome you, sir, to moderate the session.
Yeah, thank you, Aswita. Thank you. Yeah. Can I start, or would like to introduce the other panel members?
Yes, sir. I would like to introduce other panel members too.
Yeah, please.
Now, I would like to welcome our keynote speaker for the event, Ms. Kavita C. Ma'am. Kavita Ma'am currently works in the capacity of Chief Economist at Edelweiss Wealth Management, where she looks after macroeconomic research covering the Indian and global economy. Prior to this, she was with Care Ratings as a senior economist, wherein, along with macroeconomic research, she was also responsible for conducting sub-sovereign rating exercises. She has also worked at Angel Broking in the capacity of Assistant Vice President Commodities Research and at NCDEX as an economist. Besides that, she has been with Research International, a market research firm, and at Centrac India Private Limited, a market intelligence firm from the textile and jewelry sector. She has over 18 years of experience, mainly in economic research, credit rating, commodity exchange and trading, textiles and jewelry, and market research. We welcome you, ma'am. As one of our esteemed panelists, we welcome Mr. Gurunandan sir. Guru sir is Chief Financial Officer at Tata Consulting Engineers Limited. He is in a CFO conclave of the CFO India Maxim. We heartily congratulate you, sir, for being awarded today at CFO level. He has a solid academic background, CA from ICAI, LLB from BB College of Law, Manipal, Chartered Institute of Management Accountants, London, and PMI certification. Guru sir has about 3 decades of experience working with best-in-class organizations like L&T, Wipro, UTC Collins, EDS, and now Tata Consulting Engineers. He has worked closely with all the regions across the globe. Guru sir has deep expertise in leadership, budgeting, strategic investment and planning, and business finance. He is a core member of the risk management activities at the corporate level, as well as responsible for engaging the board's audit, investment, and other committees on financial delivery, providing timely commercial and technical advice. We welcome you, sir, for today's session. Now, let's welcome the panelist for the event, Neha Misra ma'am. She is the CEO and co-founder of the FinLit project, a IIIT Delhi and STPI Chennai incubated financial and fintech literacy platform. She has over a decade of experience in technology and finance and has worked for corporates and startups in India and USA, including working at Wall Street, New York. Neha is a SEBI and NISM empaneled securities markets expert. She is an advisor to the board of governors at IIM Vizag. In addition to this, Neha ma'am is a global speaker, having spoken at multiple international platforms like the 10X Thrive Conference, Women Tech Conference, Code for America, Dell Women's Entrepreneurs Summit, Think India, Reliance AGM, HDFC AGM, amongst others, and an advocate for financial literacy in India. Neha ma'am is a mentor for IIT Madras Alumni Association, IIIT Delhi Innovation and Incubation Center, Google Internet Accelerator, and the Oxford University Women in Business. We welcome you, ma'am. Now, I would like to invite our next panelist for the day, Rohit Raman sir. He is the CEO of Blueant Investments, a financial professional having 20 years of expertise managing financial products. At Blueant, he provides flexible end-to-end solutions that help individuals to meet their financial objectives by tracking and reorganizing their investment, insurance, and tax management tools in order to meet their bottom line financial goal. Rohit sir also has a fair understanding of financial and risk protection products and can help investors to build a good balance in equity and debt market. Prior to this, he also worked as an area manager at Max Life Insurance Company Limited and also as project manager at PharmaLink. Rohit sir holds an MBA degree from Nagpur University. We humbly welcome you, sir. Now, I would like to invite our next panelist for the day, Kumar Shankar Roy, sir. He is Senior Assistant Editor at the Hindu Business Line at Chennai. He is an experienced financial journalist with a solid work ethic and orientation towards outcomes. Also, Kumar is a renowned writer, editor, commentator, and analyst for personal finance. In the business line portfolio section published on Sundays, he covers stock markets, personal finance, mutual funds, and investment products for domestic investors. Kumar has a rich experience of 16 plus years and has previously worked with marquee media brands such as The Times of India, Trust of India, Outlook Money, Deccan Chronicle, DNA, etc. Academically, Kumar is a graduate in microbiology and a master's degree holder in journalism and mass communication from the University of Calcutta. We welcome you, sir. Now, let's welcome the panelist of the event, Rohini Sanyal ma'am. She works as the India Research Economist for the ISI Emerging Markets Group. She has been a key contributor to CEIC's India GDP Nowcast and is responsible for all India editorial content that is available on CEIC. She has a master's degree in economics from the University of Warwick in UK and has 5 years of experience with research institutes in India such as the National Council of Applied Economic Research. Rohini ma'am has also worked for the management consultancy Bain & Company. We welcome you, ma'am. We also have our respected director, Professor Manoj Tiwari sir with us. The event could not have been possible without the exceptional leadership of him. Professor Manoj Tiwari sir has demonstrated history of working in the manufacturing and logistics industry. Sir is skilled in mathematical modeling, supply chain optimization for developing random search algorithms for manufacturing and logistics operations, for executive coaching, research-based teaching in the domain of manufacturing operations. He has a PhD in flexible manufacturing system. With this welcome remark, I would like to request our director, Professor Manoj Tiwari sir, to share his few thoughts.
Ashwita, Manoj sir couldn't join because of an issue. You can continue with moderator's introduction.
Yeah.
Okay, Ashwita, can we start now?
Sure, sir.
Yeah, very good morning to all the panel members and to Sir Hemadati, Dean Student Affairs. It gives me immense pleasure and pride to open the discussion on Union Budget presented by the Finance Minister this year. Any budget is a primary instrument which gives life to the aspirations of the governments. It aids in controlling the economic adversities as well and promotes the performance and the growth. This year budget rests on the 4 pillars primarily. One is Prime Minister Gati Shakti. The second one is inclusive development. Third is productivity enhancement and investment, sunrise opportunities, energy transition, and the climate action. Finally, the financing of investments, primarily insisting on the green investments. Okay, and this year the highlights of the this year budget are India's economic growth estimated to be at 9.2%. And the fiscal deficit is around 6.4% of the GDP for the year 22-23, and the capex target expansion is by the 35.4% as indicated in the budget. The taxing digital assets at the rate of 30% is what has been proposed. A launch of blockchain-based digital rupee starting in the current financial year 22-23 is one more important feature. And the battery swapping policy for the electrical vehicles has been proposed by the government. And the procurement of wheat and the paddy under the MSP scheme, the minimum support price scheme, operations by the allocating almost like 2.3 lakh crores by the government. With many more such interesting reforms, the Finance Minister has come with the budget and presented to the Parliament in 2022, which is a big effort by the government to boost the Indian economy. And hope this will be a fruitful session and discussion which will make the students and the other participants take away a better picture about the way the decisions are being made by the country's bureaucrats and the politicians and the leadership. Now, I would like to request the keynote speaker of the day, Kavita, Chacko, Chief Economist of the Edelweiss Group, to take over the session for further discussion on the topic, Post-Budget Analysis 2022. Okay. Yeah, now I would like to invite the panelist, Neha Misra. Madam, over to you, please.
Professor Venkateshwarlu, I think Kavita ma'am will go ahead.
Yeah. Okay. Thank you, Professor.
Sorry, I
Very-
think the okay, yeah.
No. Yeah. A very good morning to my co-panelists, professors, and students of NITIE. And thank you very much for inviting me to speak at this forum. It is indeed a pleasure to listen to. Would it be a pleasure to listen to my co-panelists and even have an interactive Q&A session with the students and professors here. So I will just share my thoughts about the budget, from the macro perspective. Okay, the FY23 budget announcements, in my view, have been quite progressive and forward-looking. It has focused on investments, inclusive and sustainable growth, innovation, and all-inclusive welfare, which, according to me, is the need of the hour. There has been an emphasis on digitization and of using technology. Okay, these measures are viewed as facilitators of growth for the future. And when we are talking about future, it's really the long-term future that we are talking about, not just FY23. Also, the plans to create portals for healthcare and education are seen as being taken to ensure inclusive growth. And all this has been alongside the reforms and measures targeted at further simplifying the ease of doing business. Okay, and the budget has also included measures for sectors which have been most affected by the pandemic. A notable one which I would like to point out here is the Emergency Credit Line Guarantee Scheme, which is a scheme which provides government guarantees to banks and NBFCs for loans extended by them to businesses, and this has been extended by a year. And this was a special pandemic emergency measure. And not only has the government extended this facility by a year, they have also increased the guaranteed amount from 3 lakh crores to 5 lakh crores. And within this, 50,000 crores has been earmarked for the hospitality sector. So what we can gather from here is that they are trying to provide relief to all those sectors which have been continue to be affected by the pandemic, because the pandemic is still not behind us. At the same time, they are looking at new avenues and new areas of growth and inclusive welfare. That said, the budget did not have any direct consumption stimulating measures. Okay, so herein what we can read is that the boost to this is expected to come from the higher levels of activity and employment that could be generated from public investments. So, because they have not given any tax reliefs or, any changes in the slab rates of taxes, which typically can boost consumption. And what we need to keep in mind here is consumption and demand in the country continues to be weak there, and, it needs to see a durable growth, which currently is missing. Okay. Also, the budget has not quite looked at enhancing savings, because they have not done anything to provide incentives, or they have not enhanced the limits for investments under the various sections. One of them could be under Section 80C. This was one expectation which was there, that the government might come up with these measures, but they did not do that. So on the consumption and private savings front, not much has been done. Now, I'd just like to brief you all about some of the finer aspects of the budget. Okay, so according to us, that there has been a nuanced balancing of finances in the FY23 budget. While expenditure has been raised, revenues are expected to only see a modest increase. Okay, and the budget, and given that expenditure is going to be higher and the revenues could be strained, the government has only provisioned for only a gradual and calibrated fiscal consolidation. We need to keep in mind that in FY21, given the unusual circumstances, the fiscal deficit had ballooned. Okay, and there were expectations that the government might go in for aggressive tightening in this budget. But what we have seen is that the fiscal deficit has not been aggressively narrowed or tightened. So, this is done with a view of ensuring that there is enough productive investment which will take place, and to facilitate that, they would have to go in for higher borrowings. Now, one thing which I would like to point out here is that the quality of government expenditure has been fine-tuned in this budget, and that is noteworthy. So even as the size of the budget or the total expenditure was raised by 5% to a record high of 39.5 lakh crores, this increase was towards developmental or capital expenditure. And this was on anticipated lines, and rightly so. Okay, the budget has emphasized on infrastructure creation. So the spending on that, however, has surpassed expectations. So the allocations for capital asset creation has been the highest ever. Okay, the budgetary allocations. So that works out to around rupees 7.5 lakh crores, which is a 24% increase from FY22. That would be the revised estimates. And, it is 19% of the total budget, which again is the highest proportion in nearly a quarter of a century. Okay, so it is not just the central government budgetary allocations for capex which has increased. They are ensuring that even the states go in and spend on capital asset creation. So towards this end, they have increased allocations to the states also by rupees 1 lakh crores. So clearly, the focus here has been higher spending on infrastructure creation, and through that, the government expects to see a boost in growth, and a revival in private spending and investments. So rather than directly going in for a lot of SOPs or the measures that could really boost consumption, they have opted to go for this, which is more durable in nature, and it is sustainable also. Now, that said, the allotments towards revenue expenditure in the overall budget have been, reduced. All these years, or revenue expenditure still accounts for a major share in the total expenditure of the government. Okay, the revenue expenditure has a share of upward of 80%, and the balance is by capital expenditure. Like I just mentioned, capital expenditure has been brought to close to 20% of the total budget expenditure. So revenue expenditure is around 81% this year. Now, this is a notable drop from 88% 2 years ago. So, the revenue expenditure was close to around 90% for the major part of the last few decades. So last two odd decades. So this year, they have fine-tuned the expenditure and increased on capex and reduced on revenue expenditure. And in terms of year-on-year increase also, it has seen only a marginal increase versus FY20. Now, here, another thing what I would like to highlight is there has been a rationalization of expenditure on subsidies by a steep 27% in FY23. Okay, subsidies have been cut across the board. Okay, notable has been the food and fertilizer subsidy, which together account for nearly 90% of all subsidies. And both these have been reduced by 28% and 25% respectively. Okay, at the same time, expenditure on welfare schemes and that provide pandemic relief to the most impacted segments have been continued. Although there may not have been an increase in allocations here, but they have been maintained and retained. In terms of schemes, most of the expenditure on schemes have been centered around infrastructure building, health and education. So that has been the most of the focus area for the various schemes, and all these schemes will come under the ambit of revenue expenditure. There was an expectation that the government would go and increase the allocations towards employment guarantee scheme, which is again a welfare scheme, and also the one for income support for farmers. But that has not been done this year. Okay, so during the course of the year, it needs to be seen whether the government would increase allocations here or incur spending over and above what the budgetary allocations have been. Now, just to brief you all about the income or the revenue side, the income assumptions for FY23 are quite reasonable. Okay, the collections from the various tax sources are expected to see a moderation in growth rates and from this year. In fact, FY22, there has been a very healthy growth in tax revenues. So that is not expected to be replicated in FY23. And also the disinvestment target has been trimmed and made more realistic. Okay, because year over year, we have seen in most years the disinvestment target has really not been attained by the government. So for the FY23 budget, they have really trimmed that number. And their expectations are probably that number might be realized. So just to put it in perspective, the government's revenues are budgeted to grow at 6%. This is against the 27% increase of FY22. Okay, and this increase would again be led by tax revenues, which has a close to 90% share in the total revenues. And tax revenues this year are expected to grow by 10%. Okay. On the other hand, non-tax revenues are expected to be lower, and this is mainly because of the lower receipts from interest income and dividends from public sector enterprises as well as the RBI. Now, the expenditure is going to be higher. Some of the revenue heads are going to be lower. Okay, so then the fiscal deficit for this year is going to be sizable. The fiscal deficit is projected at close to 16.6 lakh crores, which based on the projections given, GDP projections given in the budget, would work out to around 6.4% of GDP. Now, to finance this fiscal deficit, the government would have to rely on market borrowings, okay? And as a result of which, the market borrowings this year, the coming financial year, are going to be sizable at over 15 lakh crores. In percentage terms, it would work out to be a close to 40% increase over FY23. Now, when there is such sizable market borrowings, it has implications for bond yields and in turn, cost of borrowing in the economy, okay? Now, the area of concern here is, although the budget, what was projected was, seen as quite balanced and realistic. Now we have these recent headwinds which have come, the recent geopolitical crisis and the wide-ranging economic implications, which are just coming about, and really nobody has a true sense of what it might be, other than that it could be quite severe. And this could really upset the fiscal math for the government, as was laid out in the FY23 budget. If this crisis prolongs, and there are no visible signs yet that this crisis is really going to subside in the near future or immediate future. Now, the rise in crude oil prices and the inflation that would come about with it, would perforce necessitate fiscal support by way of from the government, and this could be by way of reduction in tariffs on transport fuels, and even higher subsidies on food and fertilizers. I had just mentioned that, in FY23, they had gone about reducing subsidies significantly across the various segments. Now, in case this crisis prolongs, fertilizer prices, which have already shot up, could, further spike inflation. So, and it could even the higher cost of fertilizers would be difficult for the farmers to bear, as a result of which they would have to come out with some kind of subsidy for fertilizers. Likewise, if for prices of food items increase, they might also have to come up with increased food subsidy. So all of these things would have a bearing on the government finances. That is, expenditure would increase on account of subsidies and any other kind of fiscal support. At the same time, on account of the reduction in tariffs, be it on transport fuels or on some customs duties on some import of food items, the revenues would fall down. Okay, and this in turn would have implications for the fiscal deficit. So the fiscal deficit could widen, okay, from what has been budgeted so far, which is at over 16.6 lakh crores. And to finance that, the government would again have to increase their market borrowings. So these are some things, which we will get a picture in coming days, and, depending on what the geopolitical situation is. So this is surprising that even though we do not have any direct impact of this crisis, because, our trade relations with Russia are limited, it is just about, the direct trade impact is limited. We have only about, less than 3% of bilateral trade, of the total percentage of bilateral trade between India and Russia and Ukraine is just about 3% of our total, foreign trade. Despite that, the indirect impact of this via the financial market and via price rises could be significant for India. And that is an area of concern as well as challenge for policymakers, both the RBI as well as the central government. So that is something which we'll have to know. And, even though these budget numbers looked good at this, just a month ago, at the evolving situation, we don't know how much of this is really going to sustain, how it's going to hold, So yeah, that is on part of the budget from my side.
Okay, yeah, but it is quite comprehensive and a very critical review of the budget. In addition to the recent happening of the Ukraine crisis and the Russian crisis, also you addressed it very well. Now over to the next panelist, Neha, Mr. Madam.
Thank you, Professor Venkateshwarlu. Kavita ma'am, you actually summed it up so well. There's not much left for me to sort of throw light on. But perhaps, a different perspective from someone who comes from a startup, something which comes under the umbrella of an MSME or a startup, and how these things will play out. Every budget has anticipations. Every budget has things that we would want it to have, and it does not have. Like you mentioned, the ATC, it's like, I think middle class and people like us were really, really looking forward to something like that. And every budget has something that, that tips it off and sort of causes a frenzy. I think for this budget, the focus was the tax on crypto. I think for a lot of youngsters who are watching this and are logged in here, I think that must have set off the alarm, whether should I have a WazirX account or should I not have one? Should I be trading or should I not be trading? So perhaps, a few points from my perspective as well with regards, and I'm only going to add to what Ma'am Chacko already said, is one of the features around the emergency credit line guarantee scheme. Now, a lot of young people who are startups, sometimes come to us and say, how is it going to impact me? Because it's something which, and as an MSME, you only qualify if your turnover is upwards of 100 crores. But what they fail to realize is the spiraled opportunities it creates in turn for startups. So especially for MSMEs who were hurt by cash and were sort of burning cash over the last couple of years, owing to the pandemic, providing them like a stick, to hold on if you're sinking. That's a huge thing, providing them that extra credit to avail, on an existing collateral where you don't have to sort of run around to get more collateral is a huge step in itself, which we sometimes miss, from our perspective. So I think that was something which was very, very important. For startups, one of the very peculiar features is that you can avail a tax holiday for the first 3 years or any 3 years in your initial functioning. That same has been extended to startups which have been incorporated now up to FY 2023. I am a startup founder. I know how much that means, when you can save a little bit in paying your tax and in turn sort of go around and, invest on your infrastructure or invest on your research and development and on the resources that are available to you. Now, I come from a space where sustainable finance is something which I really, really admire and I advocate for. In fact, when I was speaking at the HDFC AGM, I was telling them that you should have sustainable bonds, you should have schemes which can in turn sort of, provide for the earth in the long term and, bring that ecosystem support. So just, focus on the EV sector or the battery as a service sector. Focus on the mobility sector wherein, companies which are thinking about these ideas or youngsters who are thinking about these ideas know that the government is also working with them, provides an added impetus to say that, no, this is something that I need to work for. Another important feature was with regards to the blended finance aspect, So when we say blended finance, it means that today the government funds startups at very early stages. There are smaller tied grants, other grants which are somewhere around 25 lakhs. However, when these startups grow up and become the Baijus of tomorrow, the government doesn't really get much. So when the government says that I'm going to continue hand holding and I'm going to infuse 20% of the finance requirement for startups at different stages, again, it says that no, there are institutions like SIDBI, there are institutions like the National Infrastructure Investment Fund, which can support me in my journey if I keep, working for a cause. So I think that was something very important. I've been witness to the Beating Retreat this year in New Delhi, and there was a IIT Delhi startup, which was a drone startup. They had about 1,000 drones which flew up in the air and formed mesmerizing patterns in the air. And today, that same startup is now providing that drone infrastructure for the defense sector. So I think that was something which was very, very important, and the budget sort of provided that support so as to say that yes, if you invent for the defense infrastructure, which becomes increasingly important in the wake of today morning's events that has happened off the coast of Pakistan, or in the sense of the other geopolitical scenarios that are changing, I think that's something which is very, very vital. To sort of come to an avenue which is a sensitive area in India, again, something which has, both a lot of people who advocate for it, a lot of people who are my kids tomorrow. What if that US dollar, note gets demonetized? What are you going to do in that case? Anyway, any currency which is still backed by the sovereign has a little bit of legal tender, a huge legal tender which is associated with it. So at least a step in that regard to sort of, impose a 30% tax on any income that you can generate out of these digital assets, including your NFTs or any other virtual asset, I think is a huge step to at least tell people who thought this is gambling to start thinking about it as this is not gambling. This is serious business. If I have to get into it, at least let me learn about the other aspects which are associated with it. You have to get into it, learn about volatility, But these are people who just jump into it thinking that, this is a quick buck scheme, something like a Ponzi scheme. And I think the RBI governor also reiterated that aspect about a few weeks ago in the monetary policy as well, in saying that this is not a Ponzi scheme. Just be careful about it. Now, while the budget did not really have a lot of, clarity with regards to how the central bank digital currency will play out, what is important to understand is that they have now at least started thinking about how the CBDC will work. All of us are aware that the CBDC has been, China has already started promoting its digital yuan. So somewhere I think as the government, to safeguard interests of public who are running towards private currencies, we will see a CBDC that will come into play. We will see that happen sooner or later. What technology it will be built on, whether it will be distributed or non-distributed, whether it will be tokenized or non-tokenized, only time will tell. But at least to sort of, tell youngsters that if you want to do a virtual currency, which is of course good, people who pay taxes want to do that, want to have a transparent system, there will be a CBDC that will come into play. There will be a CBDC that will help in reducing costs for the government as far as the settlement is concerned. So that is something only time will tell. But yes, a few hits and misses with regards to this year's budget. I had personally a little more expectation with regards to something for the personal finance sector, for people who pay taxes, as a 4G wife, for a little bit more for the defense sector as well. So I think maybe perhaps, if you sort of promulgate this at a larger level, perhaps we could see a few more changes in next year's budget. But that's all from me for now. Thank you. Thank you so much for having me.
Thank you, Neha, madam. I think it's a different perspective on the budget, primarily on the focusing on the startups and the.
So, if I may share my screen,
Sir, I
let
passed
me know when it. Yeah, let me know when it is visible.
It is visible.
Yeah, visible.
Okay. So I have a few slides to show, and one is the backdrop of the budget. The second is the economic survey, which is the foundation of the budget, and what has happened in the past. Some key growth engines that, of course, Kavita has already brought those up, so could be a repeat, but I'll try and condense it. And then finally, policy announcements and some concerns which were not addressed probably. So first of all, I may go to the backdrop of the budget. Of course, we went through 2 years of COVID and 3 waves of it. Labor had moved away from its normal work location. We've seen a high-priced oil in the past few months, which is going to definitely affect our budget numbers. There's a global surge in commodity prices. Inflationary pressures have built up and are visible. If you look at the nominal growth rate to the real growth rate, this is definitely visible, and quite a bit of it is also coming from global pressure. And lastly, in terms of regulation, crypto and similar assets were outside of the budget, and this year probably they have been brought in. Now, the point that Neha brought up, of course, was that is it gambling? Well, I don't know how you would call it, but definitely any income from gambling or horse races is included as part of your income. So it is taxable. Now, on the other side, on the positive side, probably vaccine doses have crossed 150, maybe 160 billion doses. So number of people are currently vaccinated. So I think that, fear is slowly going. Launch of PLI schemes, which were, from the previous year, have gone on well. There is a strong step in terms of disinvestment. AI has already happened. That is Air India. We were one of those bidders who won it, and LIC is on its way. Hopefully, it'll come through this year, if not early next year. But then the disinvestment numbers have also been pruned. Indirect tax transfer, which was one of the issues that came up in a couple of cases, especially the Vodafone case. There has been some withdrawal and more, I would say, clarity in terms of what long-term taxes will be. There's robust growth in direct and indirect taxes, especially the indirect taxes, which were around 150 lakh in the previous lakh crores in the previous month, which means, if you multiply this by 12, you are likely to have much higher revenues than what has been projected. There's a bounce back in the economy. We have seen that both in Q2 and Q3. And therefore, my assumption is that the tax revenues that have been planned could be a little, lower than what it should be. There's tremendous growth in fundraising. We've seen that. Of course, some of the issues that are there today in terms of geopolitical are pushing this back, but we have some of the largest number of unicorns in India. FX reserves have been very high, and wealth sharing via ESOPs is something that has been a positive. In terms of economic survey, I will not get into the details, but certainly one of those things that is concerning, of course, is the fiscal deficit, which has gone substantially high in the current year, but it is likely to be brought down progressively, like what Kavita said. It won't be a step change, but it is certainly going to go down from 6.4 that is planned in the current budget year to probably around 4.5% in the next 2-3 years. That said, external sectors, the reserves are quite good. Monetary management is something that will accelerate as business picks up, both in terms of local domestic business as well as exports. And investments are going to come not just from the government, but also from PPP projects, as well as from the private sector. So that said, some of the underlying assumptions for the budget, obviously COVID not going to be a threat. General optimism is there because of the various policies and the positive signals that have been given by companies. Tax revenues could be higher. This is my expectation. Stable policies are what have been, underlined in this budget. Tax standardization, there's not been much done on the tax front. I agree on that. But then it is a very good thing because you are now seeing more stability in the tax policies. PLI schemes are good to have. We should see whether there'll be a lot of movement of business or opportunities from China and now from Russia probably, because Europe, which was a big consumer of Russian made products, is probably going to cut down that. Scrapping policies which have been brought in perhaps will help the auto companies, but it is certainly an issue in terms of ESG. We'll need to look at that. No new taxes, wealth or estate is also a positive. Productivity, I think linked investments are going to be higher. Customs barriers are going to be brought down, and therefore localization is highly encouraged. You will see that in the defense sector where allocations are above 6 lakh crores and almost 68% is supposed to be local. This is a huge thing, and there is going to be a lot of activity around this. Now, the last point that I have here is execution. How will we execute all these things to see a positive growth in the economy, and what is going to be the process through which it will be brought together? Because infrastructure, when we talk about infrastructure, there are many areas of infrastructure growth: aviation, highways, railways, power, telecom, gas. You also have others like the hydrogen energy that we're talking of, Gramin Kalyan. You have metro lights that were announced in the previous year, air pollution, etc. How do all these come together is a question mark that the government probably put for itself, and some of these will now be sort of channelized or coordinated or synchronized through the PM Gati Shakti National Master Plan. That said, budget at a glance, I think Kavita has brought this out quite well in terms of what is the share of revenue expenditure, capital expenditure, the fiscal deficit, which is of course 16 lakh crores, and it's a 6.4% of the GDP. But the good part of this is probably that 45% of the fiscal deficit goes towards capital expenditure. And that is what I wanted to, sort of emphasize here. Disinvestment, of course, is going to be a key thing, but it has been, sort of trimmed down to ensure that we don't have too much, I would say, imbalance in the revenue side. Now, this is where the real versus nominal GDP is looked at. Real GDP in the previous year was 17.2%, and 8.8 was 17.2 was nominal and real was 8.8. Now there is a huge gap between the two, obviously, which means that inflation is picking up, and that inflation has suddenly been planned at much lower levels in the FY23 budget. So I'm a little, not too sure whether this kind of inflationary pressures are going to tame down at any point. It is going to continue with the new geopolitical situation. In fact, it is even higher. That said, a few policy announcements that came from the budget. Of course, the heavy, I would say, reliance on infrastructure is one of that. The Gati Shakti, PPP, low-cost housing, rail, metro, etc. There's a lot of emphasis on digital and digitech like we saw EdTech, data centers, postal savings, drone focus, etc. There's emphasis on fertilizer and chemicals also in terms of chemical-free farming, specialty chemical trust, etc. And climate change and energy is going to be a huge emphasis within the budget. Of course, Atmanirbhar Bharat, PLI schemes, and R&D have been given enough focus. Now, SEZ Act is one thing that is supposed to be revamped. We haven't seen the new version of that, but I guess from what we have seen in the SEZ, purely expecting only export turnover to come out of the SEZ has impacted many companies, and they've actually brought down their operations in the SEZ, which I think is going to be opened up a little, and more opportunities will be given for domestic manufacturing. That's what I believe. We'll have to wait and see. Sunrise sectors, again, green, clean energy, etc. Mobility, pharma, 5G, all these have been given a lot of emphasis. Not to forget metro as part of the infrastructure. Again, not to forget the national infrastructure pipeline, which was announced in the previous year. All these together, along with Jal Jeevan mission and other missions that have been there for the past 2-3 years, are going to have a significant impact on overall growth. Now, the question is really why has some of the revenue expenditure been reduced? I believe that some of the revenue expenditure, which sometimes went to giving opportunities to low income people like the Manrega and others, are probably going to translate in through the infrastructure projects that are going to give them jobs, and therefore the the allocation for revenue expenditure is down, but the total value probably remains. While the percentage is down, the values remain. Now here, I think India from 75 to 100 is something that was a theme that was emphasized on. It was called Amrit Kal, and some of the objectives of this scheme are essentially to bring about comprehensive development, that is bringing all these high value, high impact projects together between roads, rail, airports, multimodal transport, ports, urban infra, 5G to various villages, defense production, and every other thing that is outlined in the Gati Shakti. That's one of that. And then prioritize and ensure that there is a cohesive method of building infrastructure rather than the broken ships that used to sail on their own in the past. And of course, one of the key things that is happening is analytics and dynamic review of projects through a centralized portal that the central government has created. Of course, these will also include some of the state projects, and as well as some additional 1 lakh crores have been allocated for state-based infra projects. Now, finally, I think something that Neha touched upon. These were some of the key forward-looking steps in the digitech sector, whether it is 5G, EV, green manufacturing, tax policy digitization, as we have seen, e-payments gateway that is being planned or rather put in place, drones, and of course having our own currency is what we have looked at, and these I think are going to drive India's growth, and I'm sure there'll be all-round prosperity as a result of this. One thing that I want to underline is that while it is the government's race in a a long-term race that they're doing today. They are in the last few meters because the elections are out in 2024, and perhaps this budget should have been more election-oriented budget, but it is a growth-oriented one. So I think the government has not lost focus, is looking at digital and infra as their key themes, and around it a number of other opportunities have been seen together. That's what I see. In summary, Gati Shakti, inclusive development, productivity and sunrise sectors, and a lot of financing related choices that were brought together is bringing focus and a long-term vision to this government's plan of 2030 or 2047 or even 2070. This is what I wanted to bring out through this presentation. There are other slides in the presentation which you could take a look at, but I will stop here, and you can share this input, which I've already done, with your institute. I'll stop here. Thank you so much.
Yeah, thank you, Mr. Gurunandan. Okay. In fact, you could integrate both the economic survey and the budget documents. Okay. And it's a very quite insightful presentation. So now over to the next panelist, Mr. Kumar Shankar Roy.
Yeah, hi. Am I audible?
Yes, yeah, very much. Yeah.
Thank you to my co-panelists for a wonderful session so far. Actually, it's been a kind of a refresher course, I'm sure, for us as well as the students here. From a journalist point of view, you would appreciate that the budget, I have covered 17 budgets so far. So what happens is there is a bit of drudgery that gets involved in covering budgets. No? So it begins at a time, it ends at a time, and then we are supposed to send out information to everybody who's watching the budget, who wants to react to the budget. And given how financial markets are, so I would, instead of going into the hard numbers, which my co-panelists Kavita and Mr. Gurunandan and wonderful impromptu session by Neha, I think she's really brought out what happened in the crypto part. I would like to talk about something about fiscal consolidation. Although this term, it gets a lot of attention from economists as well as people who are interested in macro. It may not be something that the students or generally a person who does not take so much interest in finance, they might be interested. I come from a background educationally where economics was not something that I actually studied. So from that perspective, I would like to break down the budget in a few things and also put in my journalistic flair, if you will. So you would know that this was, I mean, from a timing perspective, this was a shorter than usual budget speech by finance minister. But what it did was it packed a punch. And although there were no populist announcements, much to chagrin of people, and also there were no measures that were aimed at particular constituencies, which has been there in the budget all the time. The central theme of the speech, as well as the budget exercise, as we have realized, and also the presentations that has been come out, it was investment in infrastructure and development. At the end of the 90 minutes, I mean, from a journalistic point of view, what we noticed was both the stock and bond markets were left breathless, right? The stock market was, excited, and there was a lot of excitement. The bond market was filled with trepidation, and both with very valid reasons. Now, this budget was, there are always these high expectations when a budget is about to be presented. Now, economic survey, as you know, kind of forecasted a growth rate, and that is what markets kind of anticipate when the economic survey comes in. And what happened was markets were expecting the government to announce measures to support the weak consumption. Now, that's the kind of backdrop in which this budget came in. Instead, I mean, this is according to me and obviously to a lot of other people, the government continued on its course to improve the quality of its expenditure by focusing on investment growth. Now, we might, depending on the side that we take, we might be happy, unhappy. But what happens is when somebody chooses to take a path, they obviously think about something, and that's how they kind of progress on that. Now, when finance minister focused on the investment growth part, then obviously this little bit higher than expected fiscal deficit, obviously borrowings, that that number kind of disappointed the bond market. And as we saw on the budget, they kind of pushed the benchmark bond yield over, I think, above 6.8%, if I'm not wrong. Now, what was this all about? Now, from my perspective, I see, and I think one of my co-panelists mentioned it also. I think it was a capex-led consolidation, and to borrow a term, it was like a capex mahotsav, right? So the FY23 budget faced a largely similar backdrop as last year, and so it ensured that the policy makers, I mean, it kind of required the policymakers to make sure that the fiscal impulse was maximized, so that potential growth is improved, and at the same time signaling, signaling is very important, right? Today, signaling that there is an adherence to medium term fiscal sustainability. I think that's how it was envisioned. So as expected, the fiscal consolidation in that kind of sense has been a little slow, but from our perspective, the tax assumptions that the budget has made could be probably modest. And as people are expecting on the markets, on the street, that there could be some positive revenue surprise. Obviously, as Mr. Gurunandan mentioned, and I think Kavita also touched upon that this Russia-Ukraine, this macro situation that has panned out, obviously that can, throw a spanner in the works. But I suppose the irony of everything is that the final word is often decided by the factors that are beyond our control, right? So coming back to the budget, I think this budget rightly focuses on the capex thrust, right? I think it's about 2.9% of the GDP, and it helps crowding the missing private sector, that part. Obviously, this private capex is endogenous and it requires some visible, consumption demand on the ground to kickstart. So let's see how that pans out. But very important, I suppose, is this persisting policy trade-off between growth and fiscal consolidation, right? Now, there's a dilemma that the acute policy trade-offs are there. So on one side, you have this requirement of nurturing a very nascent growth recovery. On the other side, you have this very diminishing fiscal space. And there's obviously debt dynamics attached with it. They're challenging. Now, the uneven recovery after the pandemic, they require targeted fiscal policy response. And that's how I think it should be seen. Obviously, some people might want certain things from the budget, but not everything can be, I suppose, put in the budget. I mean, that one day and that annual exercise to expect everything to come across in that thing, I suppose it is a little bit of over expectation there. But be as it may, I mean, people are entitled to expecting things. For me, I suppose this healthy expenditure to GDP ratio that we and people, experts in our paper, they expected, I think that was kind of met. Obviously, this focus on continued government capital expenditure, this was something which was heartening and much needed. But the consumption boost, especially to the lower strata of the economy, that would also have been welcome. Now, let's see how this kind of, brings together, how this all works out. I would also like to talk about, this net market borrowings. Now, what has happened is the FY23 net or gross borrowing is a number that is elevated. I think it's 11.2 trillion. Right? I think gross is a little bigger number. Now, this unusually large dependence on GSEC issuance to fund the deficit, I think that has kind of worried little bit people. But also there was no discussion on exempting FII's capital gains on debt investment. That that was a large expectation, and that was supposed to pave the way for India's entry into some bond indices. While a higher deficit obviously does not bode well for the bond markets, and obviously there is an expectation that RBI support for a demand supply of G6 will be required. But finally, I think that for all the conservatism in the numbers, I am on the side of conservatism. We know that rising oil prices, which could have, given a kind of a headwind again. So there is this inflation gathering storm on that side. There's also this risk. During budget, we probably got some hint of that there was the risk of rupee coming under strain, right? If FPIs continue to sell and continue to take out their market out. There is also this slight question mark on how this disinvestment program might pan out, because what you have seen is this probably a large dependency on this LIC disinvestment. We will see when it actually takes in place. But being from the vantage point that we have as in media, we had a couple of interviews with Nirmala Sitharaman, our finance minister, and we asked her about very important things about how they really look at the numbers and kind of ensure that the quality of numbers remains intact. So she told us that when before the budget is finalized, every government I think does that. They sit with the various departments, and what this government has been trying to do is that they are trying to project very realistic figures. And by saying realistic figures, how do they really ensure that realistic figures are projected? So what they do is they ask the departments to talk about the spread of expenditure between quarters and so on. So then they vet it from a point of being realistic or not. So after this, what happens is they really look at what the amount has been fixed for every department, how much is in the table of the house. Once the parliament approves, that's the amount that will come to you for appropriation. Now, since last year, at least on the capital expenditure front, with every quarter starting and then the month and all, the FM herself monitors every department's expenditure profile. I think that's an important part, and she questions the delays and everything. So particularly if you remember during this second wave of COVID, where there were very little people on the ground, there was a problem of money reaching to the ground for the big capex. So they undertook a monitoring, calling of every department and understanding what's going on in every ministry, particularly post-pandemic. So I think that's the kind of fiscal consolidation intent and approach that the finance minister and the finance ministry had. So as we say, we will probably find out in a year's time how things have actually panned out. But from a fiscal consolidation point of view in the FY23 budget, I think it's been a good budget which was not afraid to take a road less traveled. There's always this, and when there are certain elections coming up, there are expectations, and people all the time think something will happen, something won't happen. But I suppose what is very important to realize is that with one day, with one exercise, you are expected to cater to a large majority of the public. And I think full marks to her and her ministry, she's walked the way tightrope, right? I mean, and she's really walked it. And let's see how this kind of pans out. I'm sure we being part of such a growing economy and so many young people there and with a lot of optimism and passion to actually prove ourselves at the global stage. I'm sure we are all there and we want to grow, right? And I suppose that really helps an economy where young people are wanting to go out and really participate in the growth that is lying in front of us. So thank you so much for this opportunity.
Yeah, thank you, Mr. Kumar Shankar. As you rightly said, in fact, I too agree with you that we certainly feel that today India is much more stronger economy than what it was a couple of years back. And this happened because of the government's right approach and the growth-led policies that they have been pursuing since past couple of years. Okay, yeah. With this, can we move to the next panelist, Rohini, Sanyal?
Hi. Thank you so much, first of all, for having me. It's an incredible panel. I think most of the members have already covered quite extensively about what the budget presented. And so for my part, I think I want to take a step back and really look at what were the motivations behind the decisions of the government, what they presented at the budget. And first of all, it's really clear that it was a growth-oriented budget, as everyone has already mentioned. The government intends to support long-term growth, and especially now with the pandemic coming to an end, entering an endemic stage, supported by a very strong vaccination drive, where I think almost 90% of the eligible population has been inoculated with the first dose. So we are in a good space that way. But at the same time, now we have the Russia-Ukraine war and the impact from higher fuel prices. There's a bit of uncertainty on that front. Coming back to the budget, now if we look at the GDP breakup, then we see that the largest portion is actually occupied by the private final consumption expenditure, or the consumption bill, followed by the investment. Now, as Ms. Chacko already mentioned, that consumption, we didn't get a very big boost towards consumption in the budget. But something that we need to remember is that consumption had been sort of decelerating prior to the pandemic even. And that was sort of bringing down the growth as well, or on the overall. So this actually reflects more structural issues pertaining to the labor market, in my opinion. And obviously, this was exacerbated when the pandemic broke out, and so many job losses happened, drop in wages, particularly like in the informal sector. So now, and also we have to recall that even though there were adverse impact on the overall economy, the urban economy suffered more than the rural economy. At least that's what we know. And under the urban economy, the informal sector was something that has taken a bigger hit. So it is essential to boost consumption. And it is, so why did the government not do revenue expenditure and focus on capital expenditure this time? So one of the reasons is that, as research is showing, that when you put more, when you direct more spending towards capital expenditure, that has a multiplier-like effect, which I'll come to in a bit. I think Ms. Chacko already mentioned the cuts in the centrally sponsored scheme, and of course the fertilizer subsidy, which has been reduced. And again, the reason for that is an increase in government revenue expenditure can only provide like a temporary boost to the economy. But if you are looking at sustaining long-term growth, we need to really focus on investments, which would have a multiplier-like effect. But before I go to the investment bit, coming back to the structural decline in consumption and how real wages need to be increased, that is something that can be done only if the labor productivity increases. How do you increase labor productivity now? So this is where the focus on health, education, and skilling come into it. This is something, again, I feel that the budget has covered. I think everyone would agree when they say when I say the education sector saw a substantial push, and the involvement of technology was actually quite remarkable with the e-Vidya program, and then the television 200 television channels for learning in different languages, and also a digital university to provide world-class education. Similarly, in the health sector, we saw technological advancements in terms of the Ayushman Bharat digital mission and a national mental health program, very unique and something I think is a very need of the hour. So I think the government did hit the right points in terms of like supporting consumption, but through a different channel and not directly through direct transfers. Now coming to investment, which is the second biggest component of the GDP, and but which actually might prove to be the most important component in propelling the GDP growth. So here we, of course, saw a substantial push towards capital expenditure, evident focus on infrastructure creation. And the reason behind this, as I said, the capital expenditures during down cycles of GDP growth, an investment in capital expenditure will fuel more, it'll fuel higher growth in the future instead of revenue expenditure. And India's gross domestic investment rate, which is measured by the gross fixed capital formation as a share of GDP, that has actually reduced substantially, like from above 35% in September 2011 to less than 30% since fiscal year 2015. And of course, again, worsened by the pandemic. Now, research is again showing that, the investment in driving economic growth that is sustainable again in down cycles. So the reason for pushing forward on capital investment is to fuel long-term growth. I'm sorry, I think I'm being a little repetitive here. And I want to mention the channels here as to how investment can propel, have a multiplier-like effect actually. So investment not only increases the GDP directly, but it is also sort of generating jobs, it is generating employment, and it's also sort of boosting the need for skilling and education by generating those kind of jobs. So it's like a very wholesome sort of an impact that you would have. However, the low capacity utilization that is currently what we are seeing in the economy, that is obviously not a great space for private investments to sort of come in. This is why the government is again focusing on crowding in private investment, as Mr. Roy mentioned, so that the government will act as the role of a facilitator, where capital expenditure will bring in private investment. I think, okay, most of this was already covered. Something that I don't think was touched upon much is actually exports. Now, exports don't form a very large component of the GDP, yes. But I think in the last 2 years, the focus towards local manufacturing has come out quite clearly. And I think there is a space for India to become a net exporter instead of being a net importer, which we see in most cases. And if we look at the high frequency numbers, that the trade numbers that we get on a monthly basis, we see that exports are now actually at the highest level since actually a historic high. I only have the numbers here since 2015, but yes, historically it's reached the highest level. And thanks to the production-linked incentive schemes and this boost towards local manufacturing, there is a lot of scope for exports to pick up in the future. And in that way, again, the government has sort of helped in adding more industries to the production-linked incentives so that this dream is sort of realized. In my opinion, what the budget misses is we are focusing on local manufacturing, but what about exports of services? I think in a country like India, where we have great lawyers, engineers, and doctors, there is a scope for having export of services, especially in this digitally tied up world. So that is something I feel that there is a lot of scope which can be explored, but something that we did not touch upon in the budget. But perhaps small steps to the forward future. And last but not the least is, of course, the sustainable development component, which is something again that comes out clearly. I think Guru sir mentioned about that. So looking at the focus on electric vehicles, then on solar power, these are some of the things that we can see as a direct push towards having more sustainable, environmentally sustainable growth. And it, of course, forms one of our 4 main pillars in the budget. Reforms have been, introduced to tackle the clean mobility with greater public transportation, promotion of electric vehicles, as I mentioned. Also, solar power will now have a production-linked incentive scheme for manufacturing of high-efficiency modules. And then, talking about the overall circular economy, the impact on productivity enhancement, that has also been addressed, with a vision on transitioning to a carbon neutral economy. So I think the budget, again, agreeing with what I think everyone has put forward, agreeing that this is a growth-focused budget and it hits most of the right spots, not a populist budget, which was sort of expected but didn't happen. Again, a good surprise, I think, for policymakers. I think I'm going to stop at that, and back to you.
Yeah, thank you, Rohini. In fact, the 2 points which you covered, new points, are one is the education sector, because see, the very recently the government has announced the national educational policy. In fact, we could see a lot of initiatives by the government in this budget announcement, where the implementation of the NEP has been already started since last year, but this year we could see quite many initiatives by the government. That is one. The second thing is, this year one more new point that you added is the sustainable development. Okay, that's for promoting the green finance, and the green investments have been there in the budget announcement. And so with this, can we move to the Q&A session? So, okay. So I already received some questions from the students and the other participants, other audience. So I would like to take the questions. Okay. Yeah, the question number 1, which is to Mr. Kumar Shankar Roy. Okay. The question is, we have slashed the target privatization, the target for the privatization to 78,000 crores. And the following year's estimate was around the 65,000 crores. How are we looking at LIC IPO? Is a question to Mr. Kumar Shankar Rai. Otherwise, we can open to the other panel members as well.
We all are looking at LIC IPO, and we are all either from the seller point of view, that is the government, they want this IPO to be done, and from the other side, that investors also, there is a lot of interest. This obviously, this IPO being such a large IPO, it is a very prestigious moment also. Let us take a step back and not just think about the government's money that the government might raise. It is going to be a huge company, and listing, I think everybody is preparing for it. The timing of it is very important, right? When you are having a very volatile equity market, now the seller want to have the maximum price, and the buyers would want to have it at a slightly lower price, because that leaves things on the table, right? But from the government point of view, it is monitoring the situation. I think SEBI, if you've read, SEBI has also given their approval for the issue. And so the timing of it is very important. I think what should really not be misunderstood or misconstrued here is that the IPO will happen, and there is a definite kind of definite decision on that the IPO needs to happen. The timing wise is obviously it's not there, and because it's going to be such a large issue, it has to be planned in a good way. See, at a time where the markets are volatile, doing the IPO roadshows and getting investors to just think of it, 65,000 crores of money coming into one IPO. The retail issue alone will be larger than the any previous whole IPO. So you and then getting the anchor book investors. So it requires a huge bandobast, and so the timing of it is very important because to get a successful issue. I suppose that's how we should all look at it. Instead of the disinvestment, that target obviously, and see one thing if you've noticed about the current regime, and I am not going to wax eloquent about it, but that's the fact that they've tried to give realistic figures for everything that is there, not kind of give figures that are too huge or too big and it looks very ambitious, dreamy, and then it becomes very difficult to achieve later on. I think that is a key underlying consistency, and I'm sure that will be followed up even with the LIC IPO that is there. Thank you so much.
Okay, yeah, thank you, Mr. Roy. Yeah, see, the next question is open to all the panelists. It's something about the impact of Russia-Ukraine war on Indian economy, and the sanctions on Russia create, will they create the problems for India's defense sector? So the question is about the impact of Russia-Ukraine war on Indian economy, and will sanction on Russia create problems for the Indian defense sector? Yeah, any of the panelists, please. Yeah. It's
a hot topic. I think a lot of inputs should be welcomed here.
Yes.
Yeah, I think maybe just a couple of lines. Yeah, Ma'am Chacko, please go ahead. I think
you start. You start. I was just saying, you start, please.
No, I think in the short term, at least, not really short term, perhaps for the next 3 years, we already have defense deals which are in place, whether it is your, I don't want to name, but whether it is your submarines or your procurement of indigenous, helicopters or those kind of things, those are already in place. And from an internal perspective, conversations are still happening with Russia. I think Russia has been the longest ally for India, and I think China has a lesson to learn here in terms of, how it needs to play strategically in times to come. But as far as immediate, sanctions are concerned, I don't see a lot of impact which is coming to India directly. Yes, as far as oil is concerned, we will see, a rise in oil prices. Futures are trading somewhere around $140 a barrel, Brent crude and WTI. So it will definitely impact the stability of rupee, because then, it impacts US dollar, so it impacts the rupee. And RBI will, have to be very, very, I think, proactive in helping support the rupee at this stage. So I don't really see a lot of immediate sanctions, but yes, we had all thought that the Russia-Ukraine impact would be over in a week or so, but it has lasted. And we are seeing cryptocurrency donations go, all the way up. We've seen upwards of $7.2 billion raised in cryptocurrency by Ukraine. So how that plays out and what Ukraine is going to do and how long it's going to stick around, that's to see in times to come. But, other perspectives are welcome.
Yeah, just one thing that I would like to add is there any opportunity of, like I said, business coming into India as a result of the war?
Correct.
Like I said before, yes, like I said before, Europe is a large consumer of products that are made in Russia. And therefore, it is very likely that, manufacturing will commence in other countries, because as such, Europe is high cost and will not be able to.
Certainly, it's quite ambitious to build a road 40 kilometers a day. In fact, in addition to the willingness of the corporates to come into the sector, the second one is the land-related issues, land acquisition, and the other issues have been a serious concern for these companies to achieve the targets. Yeah, one question, which is a general question to all the panelists. One is views on the proposed amendment to the SCZ.
I could take that up to one or two levels and then ask others to chip in. See, one of those things, having been in the SEZ for many years, especially on the IT side with Wipro or with other companies, I have realized that there are stringent export expectations from the SEZ. So your exports have to meet certain targets. Of course, you have to be simply positive in terms of net exports. Now, that is one. But however, what also happens is there are many constraints in terms of, for example, even if you were to move equipment or your laptop from the SEZ to outside, we used to, we used to be asked to get permissions. Now, those over a period of time have been removed because the SEZ Act itself is about 10, 12 years old, and therefore changes have to be brought about. Now, one of those things that happened obviously is that domestic manufacturing or use of SEZ products for domestic was allowed only up to a certain percentage, and that was too small. Now, perhaps to ensure that the SEZ is fully, occupied in terms of its operations, if it has 100 or 120 capacity, then it should be fully utilized. Underutilization of SEZ assets is again going to cost companies, and therefore one of those things that might change in the new act is in terms of being able to manufacture or provide services to the domestic industry. This is one thing that will improve utilization, reduce operational costs, and overall the exporter who is working out of the SEZ will be more profitable. That is the expectation. It is a simple change in terms of the act. That is one of those things that I see. I'm sure Kumar and others will have some more inputs, having worked with the government in some of these policy matters.
Yeah, next question is to Kavita, Chacko. What are some few initiatives that will indirectly help the common man in this budget?
So, as Rohini clearly mentioned, okay, it will be the multiplier effect of higher spending, which is going to come from public spending on infrastructure. So, even though there has not been any direct consumption-related measures here, it is through this multiplier effect that the common man will stand to benefit in terms of employment and in terms of income also. In addition to that, there has been this focus or the allocation on affordable housing. Okay, so that is allocations there also have been retained at or slightly marginally higher than that of last year. So in the recent few years, we have seen that the government has been focusing on affordable housing, and this definitely it has a huge, beneficiary impact on the common man. So to my mind, these are the two main segments through which they are going to, really benefit. I mean, these are the two announcements in this budget, which, can be seen as being beneficial to the common man. In terms of taxes, there was not really any cut in tax rate or slabs, but there has been some relief in terms of filing of your taxes. Any additional income which you are there, you can declare it. You are given a window of around 2 years or so. So other than that, there has not been any direct beneficiary impact. Is my take on that.
Yes. Yeah, next
I
question.
just wanted to add two other points, I think, which also impact the rural masses. How much is a question, but yeah, they will. The national infrastructure pipeline, especially the gas connectivity to small villages, is going to impact. It has already taken off in a couple of years and will continue there, the gas side of things. And then I think some of the other improvements, like you said, in terms of affordable housing, is definitely going to be there. Welfare schemes substantially in terms of health, women, the postal savings that we talked of, the changes in the post office becoming virtually a bank is something that will help the rural masses, is what I guess, because there are where the small investments are there or small savings are also there. So 150,000 new post offices going online is a huge number.
Okay. Yeah. Next question to Neha. India's own digital currency is to be launched. How is it different from the cryptocurrency? What will the potential impact of the introduction of the digital currency on the economy?
Oh, thank you. Thank you, Professor Venkatesh. So,
Yeah.
in terms of what the digital currency is, I think it's government's way to sort of re-establish trust in the money that they have, because a lot of people are running towards private virtual currencies, which really are not money, but just some form of, asset that has been digitized and promoted as a form of currency, which escalates over a period of time, thus luring people. So when the government steps in, it sort of tries to say that, yes, we are hearing you. Yes, we know that, there is a need for increase in digital payments, increase in payments through these digital virtual currencies. And hence we are ready to step in and we will build a digital currency similar to, the others that 9 other countries have already built. So as to sort of tell people that, yes, if you want to put your money in a digital asset, do it at least with someone who comes with sovereign guarantee. That in turn sort of helps in preventing the volatility that is around these virtual currencies, whichever they may be, whether it is Ethereum, whether it is Bitcoin, whether it is the zillion others that have mushroomed. There is a segment in society which understands that technology is crucial here. So when you say that you will build something which will be sort of futuristic in nature, um, and it will provide an impetus for reduction in cash transfers. It sort of helps build people's trust in saying that no, RBI is not sleeping over it, or SEBI is not sleeping over it. We are acting upon it, and we will bring a product which will safeguard people's trust in the system. Of course, it also helps improve, the amount of money that, RBI otherwise spends on circulation of fiat currency. So we will see, reduction in expenses as far as the government is concerned once CBDC rolls out. But how it will play out, only time will tell. Again, I also want to mention about when we say private currencies or private assets, anything which is under the purview of no regulations or nothing, anyone can take the price anywhere one day, anyone can sort of, throw it down. It's very, very important because otherwise, people are getting into it without little to no knowledge, without understandings that there will be something which will be provided by the government in future. So we will see rollout of it. Let's see how it rolls out sometime later this year. But I'm a huge advocate of CBDC, and I would love to see how it sort of plays in the Indian economical space.
Yeah, one very interesting question. When have done on the digital currency?
Sorry, sir.
Yeah, the question on the digital currency is over.
Yeah, just took it up.
Yeah, next is quite interesting. One question is from one of the student. It's about the India's unemployment rate, which has been soaring. Okay, it went up to 7.91% in December 2021. And the reasons could be many, because earlier we had a demonetization, then followed by the introduction of the GST, then the past 2 years we have been struggling with the COVID. So these are the reasons. This could be the reasons. But in rural areas, it has gone up to 7.28 in spite of the good monsoons that we had in the past 2 years, against the 5.81% earlier. So how does this budget allocate to the skill development and the education help in imparting the necessary technological skills and facilitate the youth employment so that the employment rate can be brought down? Unemployment rate can be brought down, yeah.
So I think this sort of again brings us back to the whole point about the renewed focus, I would say, of the government on health and education, especially in the light of the pandemic. I think everyone is recognizing the importance of these two elements or actually the focus on human capital development in actually propelling long-term growth. So, the focus is now gone from short term to long term. Now, when we talk about unemployment, there is it's a little difficult situation for India because of the high level of informality that exists. And if I actually look at some alternative data, like let's say the Naukri Job Speak Index, and we see that formal employment actually didn't suffer as much, or I would say it was very resilient. When the pandemic happened, yes, there was a lot of a big dip, and then it sort of bounced back, and it's doing fairly well. But because we don't have much data on the informal sector, it is hard to say what the impact is. And as we can look at the primary survey data or unemployment rates, that has shot up. So I would say, in addition to health and education, the focus on skilling, we also need more formalization of work. Then maybe some changes in wages from the government. Also, startups are being encouraged, which is a good step in this direction, that we are encouraging more entrepreneurs, and that is again sort of multiplying into greater jobs. So we are now relying on quite a few, I would say, elements, but of course this is not going to be an overnight transition, and we probably have to wait a few years to realize the effects of this. So I hope that answers. Please go ahead.
Yes.
Others.
Yeah. Any other panel member would like to?
Yeah, just a couple of notes. I don't have the numbers for Mudra loans that have been given out. I'm not sure whether they are repayable loans or not. So at some point in time, will we write them off like what happened earlier? But definitely there is a huge number of Mudra loans that have been given to self-employed. And I think there is a shift from, formal employment to informal employment. We also know that the companies like, let's say, Dunzo, Swiggy, Zomato, etc., all employ informally a number of people to ferry their products. And that number has gone up substantially because people have, in the last 2 years, eaten at home or ordered from home. So I think these two numbers may not be available in a formal environment, but I think they will need to be counted and looked at when we look at unemployment numbers.
So
It
can
sort
I
of
take
is the validation. I'm sorry, just wanted to add, it sort of is the validation of the gig economy that we will see in times to come.
Okay. So can I take the next and the last question? Yeah, the question is why India's economy is still COVID scared, demand is weak, and capital assets have a long gestation period. It's quite an interesting question, actually. It's one can do a research on it, actually. So the question is why India's economy is still COVID scared, demand is weak, and the capital assets have a long gestation period. So any takers from the panel?
Yeah, I mean, please go ahead, Guru sir.
No, I'm asking the panel members to respond to the question.
No,
go ahead, please.
Okay, thank you. So yeah, I mean, again, as I was saying that, obviously CapEx multipliers take time to work out, and it's not going to happen overnight. But that's exactly the question, isn't it? That what are we focusing on? If the focus is on long-term growth, then we'd have to sort of, take that brunt in the short run to reap the benefits in the long term. So we'd have to go through this process to get there. The government had a choice whether you want to focus on growing consumption through, giving revenue, increasing revenue expenditure, giving direct benefit transfers, but they opted to not do that and focus on generating, a sustainable process of growth, which would support us in the long run. And I personally, I think I'm a proponent of that. So I would say that it's a waiting thing. I mean, of course, the consumption decline was happening prior to the pandemic. So I guess eventually we would have had to do something like this. I think the pandemic just kind of forced us to think out of the box and focus on the things that we want to do. So yeah, in my opinion, I think we just have to wait it out, unfortunate as that may be.
Yeah, any other panel members?
Yeah, just 2 points on the two topics that you talked of. One is, are we COVID scared? The second is in terms of the delays on infrastructure, the value being realized on infrastructure projects. I think there are 3 things that we need to look at on the COVID. One, we had a superb vaccination program that has been extended to almost 90% of our population. And therefore, I do not know whether there is that scare still in the minds of people. That's one. Second, government has made substantial investments in healthcare, both primary and tertiary. And I think that is a great thing that has happened during COVID, because these investments were real. There was no choice but to make those investments. That's the second one. Third is, private sector has put in a lot of money in improving healthcare facilities, as well as tools, techniques, methods, etc. And I myself know that, as a part of the group, we have done a number of things in terms of oxygen availability, in terms of, temporary healthcare facilities, etc. for people. And therefore, I think a lot of it may be temporary, but much of it is also permanent. So there is a good improvement in the healthcare side, as well as the vaccination program is positive. So I think overall, at least the economy is not COVID scared. There may be people who are stuck in some of the rural areas who have still got to come back to work, especially those who are in the infrastructure sector. And therefore, if I move from COVID to infrastructure and the delays that happen out there, it is really because many of these delays are because of poor planning. We in India give very little time for planning and more time for execution. That really leads to, cost increases which are substantial. In the West, you will see a lot of time being given for planning, and execution is on time, and therefore cost increases are low. The West sees about 5 to 6% in cost increases. We see 30% or more in terms of what is planned cost increase. So I think planning is important. That doesn't happen, and therefore timelines are not met. The second is a lot of dependence on government clearances. We do not have a single window, etc., and therefore, corporates have to go around or in fact build roads which have in between spaces still not complete, because some part of the land has not been acquired yet. So overall, I think the gaps are also there in terms of how quickly the government is able to approve some of these projects. And third is, of course, financing these projects, because these are large value projects, and therefore the method of financing, whether it is through a private investment, whether it is through a linked investment, whether it is through international funds, or whether it is in a PPP mode, boot type, or otherwise, can extend the entire project from anywhere between 3 to 5 years and go on till 10 years for execution. And subsequently, these projects are normally between 25 and 50 years. For example, today we are we meaning Tata Group is a part of the execution of the Ahmedabad Mumbai high-speed rail. It is a 100 lakh crore project. Already we are just in the first year of execution. We are seeing delays because on the one side, Maharashtra is still to give approvals. And on the other side, in Gujarat, we have some delays in terms of approving purchase orders, etc., from NHRCL, which is the parent body that drives this whole project. So just an example, one example is what I thought will help.
Yeah, see, in fact, if I can go ahead, one question, in fact, it's there in my mind, okay? See, I have been reading the union budgets and I do read some of the state government annual budgets, but I don't see any kind of a commonality, or the state budgets are in one direction, the union budget is in one direction, and what actually the union government wanted to really do, it may not be translating into the action because of the state government policies are they're different. I'm not saying all, but at least the relevant policies should be in sync. That's what is it, am I right in my observation, or could be some other reasons? Because the state governments more of the populistic measures that they do it, they try to distribute the money through the various schemes that has become very popular now, especially particularly in the southern states actually. Okay, there's a scheme for everything actually. They keep on distributing the money, but whereas the union government wanted to build the capital assets, union government want to build the capital assets with a long-term perspective and the long-term growth of the nation. But whereas the state governments are more of looking at the immediate political gains. That's what has been a serious concern.
Just like the example that I gave you earlier, the Mumbai-Ahmedabad corridor, Maharashtra has still not progressed. So, whereas Gujarat has done well. Now, obvious reasons are that there is a government at the center, which also is the government in the state. The good thing probably is that the more the governments in the state are aligned with the government at the center, everything else will fall in place. That's what I feel. Yes, there will be certain measures which are populist, locally expected, etc., which will go on, and you can't do much with that. But if you look at number of initiatives, especially since we are talking of a budget that is less consumption led and more investment led, I think there are going to be a number of initiatives which will have the need for collaboration between state and central. You talk of textile clusters, you talk of pharma clusters, defense corridors, you talk of a number of things around economic corridors, feeder roads, border roads, coastal and port infrastructure. Each one of these there is going to be a heavy investment, whether it is roads, airports, or otherwise, where the collaborative need is there between the state and the center. Only then will we see a lot of value that will come out. Only then will we see the programs getting closed on time, which is the other issue that is always there. The third point that I have here is that the government has made a lot of investment in technology, and many of the projects are getting centrally reviewed in terms of the progress, the speed of delivery, etc. And many of the portals are available to all the governments, all state governments, all ministries in the government. And this is going to be a significant change from what it was earlier, a disoriented, no synchronization, etc., that used to happen, is now going to be brought together substantially. And I think that is the reason for the Gati program also overall. So these were the 3 points I had.
Yeah, thank you. Yeah, please.
I would just like to add here, okay, when you are talking about the difference in the expenditure of state government and central government. See, there are certain expenditure heads which come under the purview of only the state government, like health and all of that. So perforce, they have to incur higher expenditure on those counts. So they are not really covered under the central government. And in my experience also, that the state governments tend to incur higher capex as a proportion of their total expenditure. So the central government, it's only in this budget that they have, in a meaningful manner, you can say, increase their capital expenditure as a percentage of total expenditure, and that has come to close to around 19%. Whereas for many states, for historically, okay, this ratio has been close to 20%. Okay, despite they having to incur a lot of, and some of these measures which we term as being populistic also, okay, some states see it as being necessary, okay, as being required to keep the economy in circulation. Especially when you had your pandemic period, okay, a lot of them went for heavy fiscal deficit, okay, did not really try and curtail it, and went on giving out, direct cash benefits, or going and, giving door to door, going and giving food items and things like that. So the rationale there was it helped to keep the economy in circulation. And it actually translated into economic growth. Case in point being Tamil Nadu. Okay, so it was one of the few states in 2021 that had a positive GDP growth. All the others were in contractionary territory. So this is one thing which helped to keep that in circulation. So yeah, sounds populistic in some aspects, but sometimes it has an underlying economic edge also.
So, any views from the panelists on any of the points that would like to share?
I would like to touch upon this last question. From a point where you feel that everything is equal, then homogeneity can be expected. But when there is great income equality, great other equalities, then how the leader of that particular constitutional body looks at it will differ. I'm sure students as well as co-panelists, all of us are aware, there used to be this concept of Bimaru states, and we used to talk about it so much, right? And because at that time the regime looked at it from this concept of very Bimaru, and the central government was looked at upon more like a mother figure who would nurture and hold all their children together in their fold. The strong children will obviously take care of themselves, and the weak children would be taken care of by the mother, that is the central government. Now, with the change of political regimes, with the change of mentality, I'm sure what has happened is over a period of time, some states, as you pointed out, some southern states have this schemes for practically everything. Whether we need schemes of practically everything is probably a good question. But on a large scale, because there is inequality, often I'm sure, not to drag this on, but we come on roads and we'll see beggars coming and asking for money, right? So if you talk to your friends, a lot of them will say that why do you want to give something to the beggar? Probably that money will not go to the beggar. Somebody will collect it at the end, right, of the cycle. There is an entire gang there. And on another hand, you see a child's face and he's probably famished or she's famished and doesn't have anything, and you pay $10 and to get that smile and you want to do something for them. So it really depends on that. But to have a very homogeneous policy making at every level, where the central government, state government things at the same time, I think it's like expecting that everything, every finger in your hand is same. Unless that happens, we would really not know how that has to be operationalized. Thank you so much.
I had a point which is probably an extension of what Kumar said, and that is how and where the revenues of the government are sort of realized. If you look at it, there is a concentration of companies in let us say Mumbai, or there is a concentration of companies in Delhi, etc. So a large part of the revenues and the distribution of it, which is very important, and the fair distribution of the revenues is one which is also going to be an important will play an important step in this whole direction. So you will see a Maharashtra which is ahead. You will see a Karnataka which is ahead. You will see Tamil Nadu which is ahead, or the state of Delhi which is ahead. But the rest of them are perhaps lagging because the revenue share or the revenues that are generated in that state are not sufficient to plan their budget. Okay.
So I don't have any questions now. I did not receive any questions from the students now. All the questions were already addressed by the panelists. Okay. So if you would like to share any other views, is open to the panel members. Otherwise, we can conclude with the vote of thanks by our student coordinators. Yeah,
Again, I just had one slide to show, which I will share, which are basically concerns around what we are doing. So these were the concerns, general concerns, which I saw around the budget. One is execution, especially when it comes to defense production, skills, etc. Skills in that particular area. And if you're talking of having very high locally manufactured goods, this is going to be an important area of determination. Similarly, capacity we spoke. Financing is, you may have a number of projects, but financing is going to be a key for the long term. Especially these are infrastructure projects that will go 25 to 50 years. So therefore, financing is necessary with a very low rate, perhaps zero coupon bonds or otherwise. But government borrowings in the 10-year or 20-year bonds has already shown the color on the day of the budget itself. The bond rates went up from say 6.6, 6.7 to almost close to 7%. So it is very necessary that financing costs be kept down. Otherwise, our interest costs will go up. Oil prices we spoke. Inflation is another thing that is an issue. And taxing of some of the gains as a result of interest is also one thing that we spoke of. Now, regulatory changes that may be required for EV, ESG, digital, etc. I'm not sure everything is in place. Like for example, we spoke the SEZ Act. How and how quickly will it get implemented? Now, the other one is on clear goalposts. Have all the ministries set out in the same way in terms of goalposts, and whether the state and the center are playing in tandem. Demand supply gaps are going to be there, where it is semiconductors, oil, commodity prices have risen substantially. So these gaps will need to be closed. These will include a combination of local manufacture, which I think on the semiconductor side there is a lot of investment that is going to happen, and import. So the import costs will need to get reduced, but at the same time, local manufacturing is required. Finally, in terms of innovation, healthcare, education, skills, and R&D, I'm not sure whether the investment that are shown or the expenditure that is shown is sufficient. So these questions will continue. Innovation and R&D perhaps is going to be a push from largely private players, but the government will continue to do its part with some of the innovative organizations in its armory, like for example ISRO, DRDO, etc. Will continue to help us with the GIS and other, I would say, methodologies. So healthcare, like I said, in the last 2 years, a lot of investments have taken place. Education, we also spoke. So I think these are generally some of the concerns which I thought having put them together, I wanted to share. Yeah,
Yeah,
that's
thank
all
you.
I have.
So, thank you. With this, Mr. Rahul, are you there?
Yes, sir. Ashwita will take it from you.
Ashwit, yeah.
Yes. Thank you. Thank you for enlightening us by sharing your knowledge and experience to interpret the nuances of the current budget. We learned many things. Among those, the few points are here. How the budget has emphasized on infrastructure creation, which is 19% of the total budget, through which it sees boost in private spending. Revenue expenditure has a major share in total budget, 81%, which has fallen from 88% from 2021. How the fiscal deficit, 16.6 lakh crores, is compensated through market borrowings in future. How CBDC helps in maintaining transparency and sustainability, various policies in different sectors as discussed by Gurunandan sir, education sector and various policies through e-Vidya and other schemes. In health sector, the technological advancements have paved the way for growth in this budget. How increase in capex leads to a long-term growth. Investments boost GDP, education, employment, etc. I would like to thank Professor Venkateshwarlu sir for enlightening discussion and for moderating the session so effortlessly and at the same time projecting our theme of post-budget analysis. I would like to thank our esteemed panelists, Ms. Kavita ma'am, Ms. Neha ma'am, Mr. Gurunandan sir, Kumar Shankar Roy sir, Rohini Sanyal ma'am, for sharing their wonderful and inspiring thoughts with us. I want to express our sincere gratitude to our streets professor in charge, Ajay Kumar Panda sir, student event organization team, all the NITIE faculty members, and all the participants who made this event successful. Thank you. And
Can you take a photograph?
Yeah,
yes,
before we
I
leave,
would
if
like to request all the panelists to turn on their cameras to take a photograph. Is it done, Rahul?
yes, it is done. Thank you, everyone.
Thank you, everyone.
Thank you all. Thank you all.
Thank you.
Thank you. Have a good day.
Thank you, everyone.
Thank you. Thank you.
Thank you.
Thank you so much.
All the best.
Thank you.